Beaumont, Head of FX Structuring at Moneycorp, and welcome to our monthly currency roundup for October. For the most part, it's fair to say that currency volatility in October in the major currency pairs that we're most interested in disappointed when you consider the magnitude of the drivers and factors on offer. US elections, Brexit, and of course the global COVID pandemic. Looking at the ranges briefly now, euro dollar remained in its new normal 2-cent range between 117 and 119. This is following the 10-cent move higher that we saw in May-June time. Sterling dollar operated in a similarly narrow range for the majority of the month, 128 to 130. And it took a combination of a couple of major sterling supported stories on the 21st to break out of this range and move beyond the 130, 131 level. But this was short-lived, couldn't be sustained, and sterling soon drifted lower again. Sterling euro also stayed within a 200 pip band between 109 and 111. This probably came as a much needed relief for UK importers from the Eurozone. Remember that they'd seen the pound come off from its 120 highs in February and collapse to 105 in early March. Looking at the dollar specifically, broadly weak at the moment, as it has been for a while, with the uncertainty of the looming US election on November 3rd. This is always the case in the run-up to these elections, with investors wrestling over the economic package and policies of the incoming administration. Even more pronounced when it looks like being a close one. Polls currently put Biden's Democrats slightly ahead of Trump's Republicans following the second televised presidential candidate debate. The end of September had seen the first of the televised debates between the two. This was a pretty feisty affair with little focus on actual policies. The second had to be cancelled after Trump himself contracted COVID. He shrugged it off pretty quickly, however, and was in place for the third debate, and they got down to the business of COVID, China, race, immigration, and climate change, all pretty divisive topics indeed. Despite this division, the market still has confidence that a further US fiscal rescue package will emerge, whoever wins the election, and this has probably prevented the dollar sliding further. COVID cases continue to hit the US particularly hard, but as we know, this is a global pandemic. Investment in equities and other risk-based assets has been hit hard by the second wave, and the recovery we start to see a recovery in the summer. This has stalled as economies around the world continue to struggle to open up fully in the face of rising infection numbers. This has kept the US dollar as a major denominated currency of equities worldwide firmly pinned down. In the UK, infection numbers throughout October increased exponentially, and the government introduced a new localised 3-tier lockdown system. This created tension as many areas, such as Greater Manchester, were thrown into Tier 3 without sufficient financial assistance, in their opinion. The government's latest job retention scheme failed to stimulate UK equities sufficiently, and the FTSE 100 index remained subdued throughout the month and met resistance every time it tried to breach the 6,000 point mark. The situation here was mirrored in the Eurozone, with cases and deaths in the hotspots of France, Spain and Italy seemingly out of control again, and new lockdown measures enforced across the region. Brexit negotiations have been a major driver for moving sterling for as long as we can all remember now, and markets were nervously anticipating October the 15th as the deadline for a deal between the UK and the EU. However, this date just seemed to come and go with still little resolution or agreement. Prime Minister Johnson said he was prepared to walk away from talks and head for a no deal, and sterling was sold off. And Barnier, the EU's chief negotiator, came out on the 21st to say the door was still open. So on this day also, the Deputy Governor of the Bank of England had played down talks of negative interest rates in the UK, And this combination of factors sent the pound through its stubborn range and up above 131 against the dollar, its biggest single day gain since March. On the economic data front in the UK, retail sales figures released on the 23rd showed that Q3 activity had rebounded by 17%, albeit from a very subdued Q2 number for obvious reasons. This was a stronger than expected result and could or should have been a signal for sterling buying. But concerns about rising unemployment and the backdrop of the economy shutting down again by the time the figures came out understandably prevented this from happening. So as we sit here at the end of October, the US election is still up for grabs. Brexit deal, no deal is still firmly in the balance, and there's only one winner at the moment in the COVID battle. We'll get a conclusion to two of these issues before the end of the year, and that might be enough to give the markets more direction. And October may then be looked back upon as a bit of a case of the calm before the storm. As we know, periods of low volatility in the currency markets tend not to last for very long. So be prepared for another bumpy ride and possibly larger ranges in movements in November and December. Thanks for listening, and we'll look forward to seeing you all again at the end of next month.